If you do not understand bonds, you do not understand money. You may think you do. You may know how to save. You may know how to buy a stock. You may know the monthly payment on a house. But if you cannot see what the bond market is doing underneath all of that, then you are living inside a machine you cannot read. That is dangerous. Because the bond market is not some distant Wall Street sideshow. It is the place where the world decides what time is worth. It decides what a promise is worth. It decides what it costs to bring tomorrow into today. And once you understand that, a great many things that look random stop looking random. The house that suddenly became unaffordable was not an accident. The stock portfolio that looked brilliant when rates were low and stupid when rates rose was not an accident. The layoffs that seemed to come out of nowhere were not an accident. Most people think money is cash. I do not. I think money is time with a price attached to it. A bond is simply the cleanest contract for that price. It is a promise that says, give me your money now, and I will give you your money back later, plus a little extra for the use of your time. That little extra sounds harmless until you realize the entire modern economy is built on it. I have spent most of my life studying how capital moves, how people misprice risk, and how small differences in return compound into enormous differences in outcome. The average person thinks wealth is mostly about how hard you work that matters, but the deeper truth is that wealth is also about what system you are working inside. If the price of time moves against you, effort alone will not save you. If the price of time moves in your favor and you understand how to position yourself, even ordinary decisions start producing extraordinary results. So I want to show you the machine the way I see it, not as a textbook, not as a lecture, as a control room. Once you can read this control room, you stop behaving like a passenger and start behaving like an owner. The first thing to understand is what I call the treasury gap. Governments like to talk as if spending is some abstract public virtue and borrowing is just an administrative detail. It is not. Borrowing is the point where arithmetic takes the microphone away from politics. In 2024, the United States federal government took in about $4.9 trillion in tax revenue. It spent about $6.8 trillion. That leaves a gap of roughly $1.8 trillion. That gap does not disappear because someone gives a speech. It does not disappear because a pundit changes the subject. Somebody has to finance it. That is where bonds enter the room. The government does not march into a local bank and ask for a personal loan. It issues treasury bonds to investors, institutions, pension funds, banks, and foreign governments. In plain English, it says, lend me money now and I will pay you back later with interest. That is all a bond is at the start. A principal, a coupon, a maturity. The principal is how much is borrowed. The coupon is the interest payment. The maturity is the date when the principal comes home. Simple enough that a child can understand it, powerful enough to shape the life of a nation. Now here is where most people make their first mistake. They think the bond becomes important when it is issued. That is not really where the real drama begins. The real drama begins after issuance, when that bond starts trading against all the other promises in the market. That is where the price of time gets negotiated every day. Every hour under changing conditions, fear, greed, inflation expectations, and policy mistakes. I call the next part the yield lever. If you miss this, you miss the whole game. Suppose the government issues a bond with a face value of $100 and a coupon that pays $3 a year. Later on, new bonds come out and they pay $4 a year on the same $100. Now, your old bond looks less attractive. Why would someone pay full price for your weaker promise when a stronger one is sitting right there? There is only one way to make your weaker bond attractive again. Its price has to fall. If somebody can buy your old bond for $70 and still collect $3 a year, the yield on what they paid rises. That is the bond market. Central law. When bond prices fall, yields rise. When bond prices rise, yields fall. That is not trivia. That is gravity. Most people go through life looking at prices. The smarter investor learns to look at yields because yields are the language the system uses to reprice everything else. The yield tells you what safe money can earn. Once you know that, you know what every risky asset must compete against. And now the trap gets personal. A family goes to buy a house and thinks the bank is setting the mortgage rate. That is a comforting story because it makes the world feel local and negotiable. But the truth is harsher. The bond market is setting the base rate, and the bank is adding a spread for risk, expenses, and profit. The bank is not inventing the weather. It is selling umbrellas in the weather the bond market created. I call this the mortgage gate. In January 2021, the 10-year Treasury yield was around 1%. Mortgage rates were around 2.65%. The lowest ever recorded. Cheap time flooded the system. Buyers rushed in, demand exploded. House prices jumped about 19% in 1 year, compared with a long-run average closer to 4%. People told themselves houses had become magical. They had not. Borrowing had become cheap. Then the machine turned. By October 2023, the 10-year yield had climbed to about 5% and mortgage rates moved above 8%. Suddenly, the same house required a radically different monthly payment. Notice what changed. The wood did not improve. The kitchen did not become 4 times better. The neighborhood did not suddenly invent extra beauty. The price of time changed. That is what bonds do. They do not merely influence affordability, they define affordability. And once you see that, you also understand why the housing market looks so strange afterward. Under normal conditions, fewer buyers mean lower prices, but millions of homeowners had locked in very low rates around 2020 and 2021. Selling meant giving up a 2 or 3% mortgage and replacing it with something far more painful. So they stayed put. Supply tightened, prices stayed stubborn, people kept arguing about whether housing was broken. It was not broken. It was trapped inside the bond market. As new math. When people tell me they are waiting for a better housing market, I ask one question first. Are you studying homes or are you studying the price of time? Most are studying countertops. That is why they stay confused. But the bond market does not stop at houses. It moves next into portfolios, retirement accounts, and valuation itself. This is what I call the risk hurdle. If the government offers you a nearly risk-free return, every risky asset in the world must now justify itself against that return. That comparison is not optional. It is the hurdle rate that sits silently under every stock pitch, every private equity model, every venture capital deck, every retirement plan. Investors give this comparison a formal name. The equity risk premium. I am less interested in the label than in the logic. If a 10-year treasury yields 1% and you think stocks can earn 7%, then you are being offered a 6% premium for taking the uncertainty, volatility, and psychological punishment of equities. That is a generous deal. It pushes money toward risk assets. It helps explain why, with rates held low for years, the S&P 500 climbed from about 600 in 2009 to around 4,700 by the end of 2021. Safe money paid almost nothing, so people went hunting. But if treasuries yield 5% and expected stock returns still sit around 7%, the premium for taking equity risk shrinks to roughly 2%. Suddenly the question changes. Why should I endure the drama of stocks for so little extra reward when the government will hand me 5% for lending it money? That change in the hurdle rate is enough to reroute enormous rivers of capital. In 2022, as rates rose and bonds started offering real income again, the stock market fell nearly 20%. People came up with all kinds of stories afterwards. Some blamed headlines, some blamed the Federal Reserve, some blamed corporate earnings. Those things matter. But under the floorboards, the bond market had already changed the discount rate for everything. That is the phrase most people do not feel deeply enough, the discount rate. Every business is just a stream of future cash flows. When the price of time is low, those future cash flows are worth more today. The farther into the future the profits live, the more magical the present value can look when rates are low. That is why long duration growth stories can look brilliant in one environment and ridiculous in another. When the price of time rises, tomorrow gets discounted harder. Dreams lose weight, hope gets marked down. Speculation suddenly requires a much better explanation. I have made a fortune by trying not to fool myself about this. A wonderful business can still be a poor investment if you pay too much for future earnings in a world where the price of time is rising. A mediocre business can still look temporarily acceptable when money is free and discipline leaves the room. The bond market does not care what story you fell in love with. It reprices your romance without asking permission. And then the machine moves one step closer to your daily life. It enters the payroll. I call this the refinancing trap. A great many people think companies pay wages out of profit, and that is the end of the matter. Mature companies sometimes do. But many growing companies fund operations, expansion, acquisitions, and payroll indirectly through debt. They issue bonds, they refinance loans, they borrow at one rate today with the assumption that they can roll that borrowing later. That assumption works beautifully in a low-rate environment. It can turn savage when the environment changes. Imagine a company that borrowed heavily in 2021 when government bond yields were around 1%. Maybe it issued corporate debt at 3%. It expanded, it hired, it built plants, it promised the world. Now fast forward to 2023 and 2024. Treasury yields are much higher. Investors demand more compensation for risk. To refinance old debt, the company may need to issue new debt at 7% instead of 3%. Now, interest expense doubles or worse. Where does management find the money? It does not come from wishful thinking. It comes from cuts, store closures, paused projects, canceled hiring, layoffs. This is why I tell people that bond markets are not abstract. Bond markets can walk into your office wearing a suit called budget discipline and escort your job out the door. You may think your employer's fate depends on sales momentum, brand perception, or management charisma. Those matter. But if the debt stack rolls over at ugly rates, the bond market starts writing the script. And this gets even harsher when fear enters the room. When investors become nervous, they do not just demand a higher rate from everybody, they widen the spread between safe government debt and riskier corporate debt. That widening is the market's way of saying, I need more protection because I trust less. If you want to understand whether financial stress is rising beneath the headlines, watch credit spreads. That is one of the cleanest pressure gauges in capitalism. When spreads blow out, the cost of surviving rises for weak borrowers. The strong survive, the fragile negotiate, the reckless get exposed. That is not cynicism. That is selection. Now let me tell you where most people go wrong with all this. They hear the word bond and think boring. They hear the word yield and think technical. They hear the word treasury and think this belongs to somebody with a Bloomberg terminal and a Manhattan office. That is the old identity. It is an expensive identity. The world rewards people who can read the hidden price setter. If you cannot, you keep blaming the visible symptom. You blame the seller, the employer, the stock, the bank, the housing market, the administration, the neighbor who bought sooner, the unlucky year you were born into. Some of those complaints contain truth, but they do not put you back in control. The new identity is different. I want you to stop thinking of yourself as a consumer of financial products and start thinking of yourself as a reader of capital costs. That is one of the most important identity flips in money. A consumer asks, what is my monthly payment? A capital reader asks, what is the system charging for time right now? A consumer asks, can I stretch to buy this house? A capital reader asks, what is the benchmark yield? What is the spread? And what does that imply for affordability, refinancing risk, and future prices? A consumer asks, should I chase this stock because everybody loves it? A capital reader asks, what is the risk? Free alternative, and what premium am I really being paid for uncertainty? Once you make that shift, you stop getting ambushed so often. Now I want to go deeper, because understanding bonds is not just about seeing danger. It is about seeing where disciplined people can quietly gain an edge. The first edge is emotional. When rates are low for a long time, people become stupid in very predictable ways. They think asset prices are rising because the assets have become intrinsically better. They think leverage is intelligent because the monthly payments look manageable. They think risk has disappeared because the system has gone several years without visible pain. What actually happened is that the price of time fell. Low rates can make almost any bad idea look temporarily serviceable. They can flatter weak businesses, inflate fragile valuations, and seduce households into buying more future than they can safely carry. Then rates rise and the spell breaks. The people who survive these transitions are usually not the smartest in the room on paper. They are the ones who respected the machine when it looked calm. The second edge is strategic. If you know that bonds set the hurdle rate for everything, then you stop using old assumptions in new environments. You do not assume a house is affordable because it was affordable for your cousin in 2021. You do not assume a stock multiple is justified because it was common during the 0 rate years. You do not assume your employer can refinance forever at benign terms because it used to. This is why I have always loved simple arithmetic. Arithmetic has no ego. It does not care about narratives. It asks, what are you paying? What are you getting? What is the benchmark? What is the spread? And what happens if conditions worsen? The third edge is positional. Most people live entirely on the wrong side of the price of time machine. They are permanent buyers of expensive time. They borrow at bad moments, stretch for payments, hold floating rate liabilities, ignore refinancing risk, and then wonder why every shift in rates feels like an attack. I want you to move to the other side whenever possible. I want you to own claims on capital instead of merely renting capital. I want you to collect yield. Not only pay it, I want you to structure your life So rising rates are not always a catastrophe. That does not mean you need to become a bond trader. It means you need a protocol. And here is the protocol I would give someone I cared about. First, build a habit of watching the 10-year Treasury yield the way ordinary people watch the weather. You do not need to obsess over every tick, but you do need to know the climate you are living in. If the 10-year is moving sharply, it is trying to tell you something about inflation expectations, growth risk appetite, and the price of time across the economy. Second, tie major purchases to total carrying cost, not sticker price. A house is not just a house price. A car is not just a car price. A business acquisition is not just a purchase price. Every large asset comes with financing terms, maintenance, taxes, insurance, and opportunity cost. The bond market leaks into all of them through the required return. If you ignore the carrying cost, you are not doing finance, you are doing theater. Third, prefer fixed rate debt over floating rate debt when you must borrow, and the terms are reasonable. One of the great hidden dangers in life is waking up to discover that your personal cost of capital can reset against you. If you can lock in sensible long-term financing, you remove a great deal of future uncertainty from your life. You are buying stability when stability is available. Fourth, keep a liquidity reserve. High rates punish the person who must act on a deadline. They reward the person who can wait. Cash and short-term treasuries may look boring when speculation is running wild, but they give you something precious: optionality. Optionality is what allows you to buy when other people are forced to sell, negotiate when others are desperate, and refuse bad terms when the machine turns hostile. Fifth, demand a real premium for risk. Do not buy stocks simply because you dislike the idea of bonds. Do not buy long-duration fantasies because they were fashionable in the last cycle. Ask what safe money pays, then ask what extra return you are actually being offered. If the premium is thin, your discipline should get thicker. 6, study the debt profile of any company that matters to your wealth or your paycheck. If you own the stock, ask when the debt matures. If you work there, ask how dependent the business is on refinancing. If you cannot get precise numbers, at least learn the basic character of the balance sheet. A company that needs easy money to survive is not as strong as it looks during good times. 7th, do not confuse temporary market value with permanent earning power. Rising yields can crush asset prices in the short run. That does not automatically destroy the underlying economics of a durable business. But it does force you to distinguish between a business being good and a security being cheap. That distinction has made me more money than brilliance ever did. 8th, let the bond market discipline your optimism. When the price of time is high, I become more selective. When it is low, I still refuse foolishness. But I understand why capital behaves more generously. The mistake is to use one environment, S standards, in another environment, S market. Now let me say something that will bother a lot of people. Many financial plans are built on assumptions imported from an abnormal era. The decade after the financial crisis taught a generation that money should be cheap, stocks should recover quickly, mortgages should feel light, and capital should always find a way to forgive excess. That was not a law of nature. That was a regime. Regimes change. And when they do, people who built their lives on yesterday's discount rate wake up and feel betrayed by reality. They were not betrayed. They were overtrained by a favorable environment and underprepared for a different one. This is why bonds matter so much. They are not just a product. They are the reference signal for the regime itself, a low yield regime tells you that future cash flows will be treated generously. Leverage will feel easier, and speculative appetite will usually be stronger. A high-yield regime tells you that current cash matters more. Debt burdens weigh heavier, and weak business models will get less mercy. If you can identify the regime, you can stop making category errors. And now I want to make this practical in a more personal way. Suppose you are thinking about buying a house. Most people focus on one number: can I qualify? I think that is the wrong first question. The better question is, what share of my future flexibility am I giving away at this rate? Qualification is a bank's opinion. Flexibility is economic reality. When yields are high, you should treat every long-term payment obligation with more suspicion, not less. Suppose you are building an investment portfolio. Most people ask, what is the hot sector? I ask, what is the risk? Free rate. And what return am I demanding above it for uncertainty? That is how you avoid reaching for glamour. When safe returns have become respectable. Suppose you are choosing between two jobs. One is at a stable company with modest growth and low debt. The other is at an exciting company that relied on cheap money to hire aggressively in a low-rate regime. The second job can look thrilling. In a higher-rate regime, I would inspect the capital structure before I got seduced by the salary. Suppose you are running a small business. Do not just watch your sales. Watch your refinancing conditions. Know what happens if rates are 2 points higher at renewal. Know what happens if demand softens at the same time. A business often dies not from lack of demand alone, but from a mismatch between its promises and its cost of capital. This is what I mean when I say bonds are the price of time. They are the ruler behind the ruler. They tell you what patience earns. They tell you what leverage costs. They tell you what risk must pay. They tell you what dreams are worth today. And if you ignore that ruler, you spend your life measuring with warped wood. The beauty of understanding this is that it also makes you calmer. When the stock market drops because yields rise, you are less likely to panic if you understand the mechanism. When your mortgage quote looks absurd compared with what your neighbor got a few years ago, you are less likely to take it personally if you understand the regime changed. When layoffs spread through indebted industries, you are less likely to be mystified if you understand refinancing pressure. Clarity does not eliminate pain, but it does eliminate a great deal of useless confusion. I have always believed that most financial suffering contains two layers. The first layer is the loss itself. The second is the humiliation of not understanding what is happening while it happens. The second layer makes people do desperate things. They chase, they borrow badly, they average down without analysis, they sell quality at the wrong moment, they confuse movement with opportunity. Knowledge cannot guarantee wealth, but ignorance almost guarantees avoidable errors. So let me bring this to the final choice, because that is where this really matters. You can live the rest of your financial life as someone who reacts to prices after they move, or you can live as someone who studies the force that moved them. You can keep asking what the bank, the market, or your employer decided to do to you, or you can ask what the price of time was doing before the decision ever reached your front door. You can keep building a life that depends on cheap money staying cheap forever, or you can build one that remains sturdy when the machine turns against you. One path leads to constant surprise, the other leads to strategic patience. One path makes you a victim of the cycle, the other makes you a reader of the cycle. And that distinction will not just change your returns, it will change your behavior, your stress level, your decisions about debt, your tolerance for risk, and the kind of opportunities you are even able to see. The bond market is over $130 trillion for a reason. It is not large because it is boring. It is large because it sits under everything. Houses, stocks, payrolls, valuations, deficits, retirement income, bankruptcies, booms, and busts all pass through the same gate sooner or later. So here is the contract I would make with myself if I were starting from scratch. I will never again make a major financial decision without first asking what safe money pays. I will never again assume the monthly payment tells the whole truth. I will never again treat leverage as harmless because the last few years were easy. I will never again buy risk without measuring the premium. I will never again trust a story more than I trust the cost of capital behind it. And if you can say those sentences honestly, then you are no longer just trying to make money. You are learning how money itself gets priced. That is a different level of understanding. And once you reach it, the world still looks complicated, but it no longer looks random. That is when real advantage begins.